Hey everybody, welcome back to another edition of 5 Question Friday, where I do my best to answer questions you all have sent in. And we've got 5 great questions and then sort of an investing tip strategy thing that we'll talk about at the end. So here we go, maybe. There it is. Okay. Question 1, does anybody actually follow the 4% rule? Number 2, should you take the lump sum or monthly payments with an annuity or really with a pension? How should you invest in retirement? So you're retired. How should you invest if you don't need the money you're investing? I guess that's a good problem to have. And then 4, how should you invest if you're looking at about a 10-year time horizon, which is tricky. I'll just tell you that right now. And then 5, why do I invest in VTINX, which is a Vanguard target date retirement fund? And then as a bonus, a viewer emailed me their approach to asset allocation in terms of some specific funds, and I thought it was clever. I thought it was good, and I wanted to share that with you. So we'll dive in. If you want to send in a question, just subscribe to the newsletter. It's free, goes out every Sunday. Link is below the video, and then just hit reply. I do read every email. I don't reply to every email, although I reply to a lot of them, but I'm doing my best. Okay, here was the actual question, came from a viewer named Pat. With all the information on withdrawal strategies, have you ever actually met anyone who has been retired for 30 plus years without a pension and practiced any of these methods? It would be interesting to hear about someone's actual experience rather than back calculated computer simulations. And it's a great question and observation. I have only encountered one person who said absolutely they follow a withdrawal strategy and they followed it for many years. I actually interviewed him on this channel, and it was in that interview that he told us that. His name? Bill Bengen. Yeah. He said he follows the 4% rule. Now, today he says it's the 4.7% rule, so I don't know if he adjusted the numbers, because normally with the 4% rule, you start with 4% of your savings in year one, and then you adjust that number by inflation. So I don't know. But even with him, I would say it isn't really quite truly following it in this regard, as I recall anyway. A lot of the money he, I think, gives to his kids. So he's not, which is fine. And Mom, if you're listening, you can send me all the money you want. But, it's not exactly using it for spending money, but still, he says he follows it. Other than Bill, I have never met a single person that has followed, religiously any withdrawal strategy of any kind for a significant period of time. If you have, shoot me an email. I'd love to hear the story, and maybe I'll share it in a future video. I don't know. Now, but I think this raises an important point. It's actually going to come up in a couple of ways with the other questions in today's show. 30 years is a long time. 30 years ago, it was what, 1995? I actually looked up 1995. What was going on there? O.J. Simpson was acquitted. 1995, I remember where my wife and I were watching the Bronco go up the freeway. Oklahoma City bombing, an awful experience, an awful event, of course. But O.J. was acquitted. I mean, that was a long time ago. I think Bill Clinton was president. A lot happens over 30 years, and it underscores for me that all these different withdrawal strategies, I think they are very helpful in helping us understand the interplay between drawing income of some kind from our portfolio, how market returns affect it, how inflation affects it, how it can change over time. But at the end of the day, they're more like economic models, right? All of which are wrong, some of which are useful. And that's how I view withdrawal strategy. I think they're fun to think about and talk about and study, but I don't ever see myself following a withdrawal strategy, and certainly not trying to rigidly follow it for 30 years. It's kind of funny that and I'm as guilty of this as anyone, but we think about retirement and our plan for it in this 30-year chunk, assuming you're retiring at, say, a traditional age in your 60s. And but we don't do that, as far as I know, any other point in time. I mean, when I was 25, I didn't think to myself, okay, I call my wife into the room, sweetie, this is the financial plan we're going to follow for the next 30 years. She would have thought I was nuts. She probably thinks that anyway, perhaps for other reasons. But we don't, life just doesn't work that way. And so I think it's great to understand withdrawal strategies, and I think it can help us think through certainly what's reasonable. It can help us understand where we are on the path through retirement, and are we getting into trouble or not. But frankly, at the end of the day, I think the best approach is financial software like Boldin or Projection Lab if you need it. Some of you may spend so little of your savings, you're like, Rob, I don't even need that. I know I'm okay. And that's wonderful too. So yeah, the short answer is maybe Bill Bingen, but that's with an asterisk. Yeah, if you followed a rigid strategy consistently, let me know about it. I mean, for one thing, by the way, our expenses do change from year to year. And I don't know about you, but my expenses don't just happen to magically increase by CPI every year. So yeah, great question though. And there you go. All right, question number 2. Let's see here. Let me make sure you can see it on the screen. Should you take the lump sum or monthly payments with an annuity? This actually a long question from Daryl, and there were actually 2 related questions. One from Daryl, one from another viewer. I'm going to look at both, but with Daryl, I'll just summarize this for you. He can, and this is a pension. He can take $232,000 lump sum, or he can get $1,693 a month for his life. He's single. The pension is not adjusted for inflation. There's no cost of living increase. So in that sense, it's pretty much just like a single premium immediate annuity. They're not adjusted for inflation either. And he doesn't really need the money. Actually, he doesn't. And he likes to have control over his money. And so his basic question is, is it okay if I just take the lump sum? He points out that the 1693 is 8.7%, or actually you'd multiply it by 12. And you get, and there's this sort of rule of thumb that says if the payout is the annual payout is 6% or greater, you should take the monthly annuity. I've probably mentioned it, but it's a rule of thumb, but it's not the kind of thing that I would put too much weight on, because I think there are more important factors. So a couple of things to look at. Let's first let's imagine he takes the lump sum and actually goes and buys an annuity with it. I know you probably wouldn't do that. You just take the monthly, but let's do that. We can go to this Schwab annuity calculator, and I'll leave a link to this below the video. Single life, we're going to base the amount on the amount invested. We've got this number here. We're going to start it. We'll start it next month on the 1st. And I think he said he was 68, which would put his birthday around 56, I think, more or less. Let's see here. I think that's right. We'll say the end of the month. And he didn't mention his state. We'll just put, there we go. And what do we get? 1628. So actually he does a tad better, right? Of course, this may change depending on where he lives, but it's close. And so, but yeah, you could say, well, this is better than I could get for an annuity. So if I did want to go the monthly route, maybe this would be the better option. Before I give you my thoughts on it, I want to show you one other thing. This is a paper that was published in 1965 by an economist, I think out of Israel, Yari, if I'm pronouncing his name right. Uncertain Lifetime Life Insurance and the Theory of the Consumer, the Review of Economic Studies. And you say, Rob, that's just delightful. Why are you showing us this? Among economists, that is a famous paper from 1965. And it basically said, if you, given a whole bunch of assumptions, you should annuitize all of your wealth. Take it all, just put all your chips right onto the annuity table and annuitize everything. And I kind of get a kick out of economists because they reach this conclusion and then they look at the real world and they say, but people aren't doing this. Why isn't everyone acting rationally? What is wrong with them? And they even give it a name. And the name always ends with the word puzzle. This is the annuity puzzle. There's a retirement consumption puzzle. It's when you and I apparently don't act rationally, at least according to economists. Now, in fairness to this paper, there were assumptions in there that probably don't apply to most people. For example, one of them was you didn't care at all about leaving money to anybody. Now, there are some people that fit that assumption, but I would say a lot, maybe most, don't. But another part of the assumption is back then you could get an inflation-adjusted annuity. That was a big factor. Today you can't. And so the long story short is economists wonder why we don't annuitize, but people don't. And a lot of the reasons are what we see in this question from Daryl. He likes control of his money, for starters. I get it. You buy an annuity, you've lost control of the money. You get your monthly payment, but you don't have control of the lump sum anymore. And particularly if you don't need the money to live on, or you can, in other words, you might be more willing to take some risk with it, then taking the monthly annuity might not make sense. And of course, if you're thinking, I don't need to spend this, but I want to leave something for my kids, then you certainly, I don't think, would want to take the monthly annuity. I assume you could take it, and each time the check came in, just start building up savings again. But if you're going to do that, the question is, well, why not, just take the lump sum in the first place? So at least in my opinion, I don't think his thinking. I think his thinking on this is quite reasonable in my view. Now, the second question I got was a bit different. It was another long email from Mary. I won't go through the whole email, but her situation is different. She's got $250,000 and she's wanting to know whether to buy an annuity with it. Her brother, who's apparently a CPA, is recommending that she does. She's still working, but close to retirement. And I think we can look at a number of factors. I think there are pros and cons to buying an annuity or not. Now, but the first thing I want to say is it's not all or nothing. Like in Mary's case, she could take half the $250,000 as an example and buy an annuity. For that matter, Daryl could do the same thing, right? He could take the lump sum, but then decide, I'm going to take some of it and buy an annuity. He could do that now. He could make that decision next year or 5 years from now. And so it's not, one option or the other. It could be a combination. So where do I think annuities make the most sense? And again, we're talking about single premium immediate annuities. None of those ridiculously expensive variable annuities. We're talking about you pay a lump sum and you get a monthly check for your life. One is if you're doing it as part of an overall plan and this money will cover essential spending, not the nice things that you want like travel. Those are important, but to keep the lights on. I think increasing your guaranteed income to cover essential expenses. That doesn't necessarily mean you need to cover 100% of it, but to the point where you're comfortable that you know how you're going to pay your bills each month. Again, you're going to have Social Security. You might have a pension. I would put a tips ladder into this category of guaranteed spending as well. But certainly to annuitize part of your wealth to cover those guaranteed expenses, I think is reasonable. You have to think through it a bit because, as I mentioned, they're not adjusted for inflation. But again, you may have other things that are like Social Security or a tips ladder. And so it may be okay that some portion of your guaranteed income, like an annuity, isn't indexed for inflation. It's just something to think about. But I think that's very reasonable. I also think it's reasonable if you are, very frightened of investing. It's just, maybe you're kind enough to listen to some of my videos, but you're like, Rob, it's just not for me. Now, I hesitate to say, well, then an annuity makes sense because, again, there are downsides to the annuity. It's not adjusted for inflation. Once you pass away, the money's gone. You can buy other types of annuities where the impact of that is lessened, but you're going to pay for that in the form of reduced monthly benefits. But by and large, for the kind of annuities we're talking about, once you pass away, there's nothing left. And then again, as Daryl pointed out, you lose control of the money. And so, you get that steady check. That's the upside, and you don't have to worry about how to invest it, right? Because the insurance company does that for you. But there are some significant downsides to it, as I've mentioned, and you just have to weigh those. And again, I like the idea of asking the question, how are your essential expenses covered? If you've got them covered, like Daryl does, I probably wouldn't buy it. I wouldn't buy an annuity or take a monthly a pension. But if you don't, then perhaps annuitizing some of your money might make sense. Again, in Mary's case, I don't know the answers to a lot of those questions, but that's how I at least would think through it if I were in either Daryl's situation or Mary's. Okay. Question number 3. This comes from Kathleen. I'm 67, recently retired, have 2 IRAs that are in target retirement date funds. One's a traditional, one's a Roth. What do I do with them now that I'm retired? P.S. I don't need to draw from them because my pension and Social Security more than cover my expenses. Well, this is kind of what we were just talking about, that situation where you don't need investments. And it's a good problem to have. The first thing I would do, I'd think about a couple things here. The first thing I would do, and I might not be able to answer this right off the top of my head. I might need to sit with this question for a week or a month. And that is, am I confident I'm never going to need this money? Now, when I say that, I don't mean that there's no set of circumstances that could unfold where I would need this money. I mean, I guess that could happen. But am I going to get to a point where maybe I do want to spend this money? Yeah, maybe I've got my expenses covered right now through Social Security and a pension. But how confident am I? Remember, retirement is a long, long time. Maybe 30 years. She's 67. 30 years ago was a long time. Who knows what 2055 is going to look like? How confident are you that you won't want to choose to spend some of that money in the next 5 or 10 or 20 years? And I think that's worth giving some serious thought to. Now, if you conclude, no, I really don't, then the question becomes, well, then what are you going to do with the money? And if the answer is, I'm going to give it to charity, I'm going to give it to my children, other family members, then you're a long-term investor, right? I mean, of course, you never know what's going to happen tomorrow. But from a planning perspective, unless, someone has serious health issues, you might plan for a 30-year retirement. Certainly it's age 67. And so you're a long-term investor. And so what I would do is I would invest it as a long-term investor. Now, you still might be able to use target date retirement funds. And in fact, I'll talk about a strategy at the end. That's the bonus strategy I talked about on how you could use target date retirement funds to basically invest any way you want to, conservatively, aggressively, somewhere in the middle. But if you've got 30 years, let's say, again, for planning purposes, you're a long-term investor, I would probably have a portfolio that is significantly tilted to stocks. I don't know exactly what it would be. Part of what it would be would come down to just how confident am I that I really do not want to spend this money in my retirement. Now, I think part of the equation is, I really don't think I'll spend it, but I'm glad it's there for emergencies. Maybe I'm going to end up needing some long-term care. Maybe I have a very significant health issue that just costs a lot of money. And so I'm glad that it's there maybe for that, but I don't need it to meet my monthly expenses. Okay, I think that's a fair way to think about it. And that would affect how I invest it. But again, assuming that I were 67 and in good health, I would still personally probably invest it in a way that was tilted more towards stocks than bonds. Would it be maybe 70-30? Probably wouldn't go above 80-20 or below 60-40. But again, that's very personal to me and my own sense of risk and risk tolerance. And so that may not work for you, but that's exactly how I would think about it. Frankly, it's no different than how I think about any money that I invest. When do I think I'm going to need it? And that then tells me, is the starting point for figuring out how I'm going to invest it. Not only when I'm going to need it, but over what period of time, right? So if you think about a 529 fund, you might not need it for 18 years, but then you're going to need all of it in a 4-year time period. Well, let's say you're 18 years away from retirement. Same thing, right? Well, no, because you're hopefully not going to have a 4-year retirement. Hopefully you're going to have a nice long retirement. So it's 18 years away, but you're spending it over a long period of time. So those are sort of the factors that I would think about. Okay. Next question. How to invest over a 10-year period? I think this is one of the hardest questions I ever get when it comes to investing, this kind of thing. And the question was specific to someone Dave has a special needs brother in his mid-60s that they care for. They're managing his investments. One of the questions was, as trustees of his trust, what are the options? What are they allowed to do? Of course, I can't answer that. It's often set forth, hopefully, in the trust document itself. But here's the situation they're in. His brother has some, government resources that help him, but they have to pay out of pocket some on their own. They have about $90,000 right now, and they're spending $8,000 to $10,000, I assume, per year on his behalf. So you're looking at a 10+% withdrawal rate, and so they will run out of money in roughly 10 years. But the question is, how should they invest it? And one possibility that he mentioned is T-bills, high-interest checking. This is difficult for a couple of reasons, in my view. First of all, it's not as if you're going to invest for 10 years, but you don't need any of it until the 10-year period is up. They're spending significant chunks of this each year over the next 10 years. And so in my mind, I would not be taking significant risks with this money. T-bills might make a lot of sense. I could certainly think that some exposure to stocks might be reasonable, but it wouldn't be significant in my mind, maybe in the 20 to 40% at most. And I certainly think T-bills, at least at the current yields, are reasonable. We'll see how they move as interest rates change, and depending on what the Fed does and government debt and all of those questions. But not only is it a relatively short period of time, but you're needing $8,000 to $10,000 of it a year, so you're burning through it very quickly, and it's money that you really, really need, obviously, to take care of your brother. To me, the bigger question is what's going to happen when this money's gone. Now, that's not the question they asked me, and of course, there's no way I can answer that question or even comment on it because I don't know any of the details. But I mention it because the answer to that question might influence how I would think about this $90,000 and how to invest it. And again, I don't know the answer to it, but that's why I think it's important for obvious reasons, but also I think it could influence how to invest that $90,000. Now, and so it's a tough question. I would certainly err on the side of conservatism, and it might be T-bills. You could think of a TIPS ladder, right? Because you'll know exactly how much money you're going to get each year on an after-inflation basis, and you could build a 10-year TIPS ladder, making sure that it threw off enough money that you needed each year. And so that would be another. The nice thing about that is it's adjusted for inflation, and so you're going to keep up with inflation, which, depending on your brother's needs, particularly to the extent that they're medical, those expenses can go up greater than CPI. So TIPS might not be a perfect fit, but certainly something I would consider. And remember, it doesn't have to be all one or all the other. You could do a combination as well. So the next question I got is very similar from a viewer named Randy. So I'm actually doing more than 5 questions today, but this is an overlap. Thanks, Rob, for the newsletter. I'm retired this year. Want to protect my cash. It's in Fidelity, and I think it's a 9-year ladder. Excuse me, it's in a 9-year ladder CD at Marcus Bank. He's afraid of the stock market at the moment. Don't want to hit a home run at my age, 77. Any thoughts, suggestions to ride out the next 5 to 10 years? No debt, house paid, divorce, low expenses. So this is another question where, you've got this, he's concerned about the next 10 years. Now, what I don't know from the question, at this point, here are the questions I would ask Randy if he and I were having a cup of coffee. And these would be things for Randy to think about, and maybe you too if you're in a similar situation. The first question is, you've got it in a 9-year, sounds like bank CD ladder with Marcus. How much of this do you need to spend over the next 10 years? What are you going to be doing with it? Kind of like the question before, where they're spending $8,000 to $10,000 of $90,000. In this case, I don't know the amount of money we're talking about, but how much of it are you going to be spending during that 10-year period? Because that's going to affect how you're going to invest it. The more money you need year after year along that 10-year period, you're going to need to keep it liquid. I wouldn't be putting money in the stock market that I need over the next several years at a minimum. So that's question one. Question two is, it's in a CD ladder now at Marcus. Why do you want to change? You've said you don't like the stock market, at least not right now. So what is it about that you're unhappy with? Or maybe you just think you can do better, but that would be a question. The next question would be, if you're going to invest it in something else, so you're going to pull it out of those certificates of deposit, are you going to pay penalties? And have you considered that? How much will the penalties be? Typically, you do have penalties when you cash in a CD early. There's some exceptions, no penalty CDs and the like, but I would factor in those penalties. And then I think beyond that, I would want to see a bigger picture of Randy's financial situation. What other sources of income does he have? Why are you planning for 10 years? You're 77. Why are you thinking 10 years, which is 87? Should you be thinking 15 or more from a planning perspective? And so all of these questions would be the kinds of things I would be asking over a cup of coffee. And I think, as we got answers to those questions, you could arrive at a plan that was reasonable. That's the best we can ever hope for, right? A reasonable plan. There's no guarantees, right, with this. But I think we could come up with a reasonable plan. But those are the sort of questions that I would be asking. Again, do you need this to cover essential expenses, or is this money for things that you don't have to spend it on, but you want to? That might affect how we invest it as well. These have been tough questions. Tough questions because they don't have just simple answers. It's not like I can say, oh, Randy, the answer to your question is 13. Wouldn't that be nice? Okay. Question 5. I am considering moving part, or this is from Brad, or all of my bond allocation to VTINX. We'll look at this. Can you provide your thoughts on this? I understand you have this fund and are interested in your reasoning. Appreciate your show and rarely miss watching. So this is VTINX. It's a Vanguard Target Retirement Income Fund. It's a target date retirement fund, but it's for when you kind of come to the end of the line. You've already retired. And I put my traditional retirement account in this fund, and I put my wife's in this fund. And if we look at portfolio composition, we can see, we can go down here, it's easier. It's about 30% stocks and 70% bonds, right? Roughly. There's a little bit of short-term reserves. So it's a very conservative fund. And I use this fund for several reasons. One is, given the amount we have in traditional retirement accounts, with that fund, and then when I factor in Roth accounts, HSA accounts, and taxable accounts, it gets us to an allocation roughly in the 70 to 75% stocks overall. And that's what I want. So it had the right asset allocation that when I mixed it with all of our other investments, I got the asset allocation that I wanted. That's one reason. The second reason is it's easy. It's one fund. We have other funds, of course, in Roth and taxable accounts, but in our traditional retirement accounts, one fund and we're done. And it helps me too with my wife, because I say, look, you don't really have to change anything. Just take out money when you need it. If I get hit by a truck, it's pretty simple. And so it's very easy for my family, and it's low cost, right? It's a Vanguard fund. I think it's 8 basis points, something like that. Let's take a look. Yep, 8 basis points, which is, 0.08 of 1%, right? And so that's why I am in this fund. Now, is this a good bond alternative? Well, I think it could be. You just have to recognize that it's not 100% bonds, right? It's 30% stock, so it would have to work in your overall portfolio. One of the things, though, that I like about this fund, and let me see if it shows it here. Yeah, it has about 16% in tips, and it might have short term. No, that's it. And most funds, whether they're target date or bond funds, they don't mix nominal bonds and tips. So nominal bonds are just your regular bonds, corporate bonds, U.S. government bonds. You tend not to find both regular bonds and tips in the same fund. And in this one, you have it. And they also throw in international bonds. I don't feel a strong need to own international bonds, but if Vanguard's going to do all the work on this for me, I don't mind owning international bonds. It gives me a little more diversification. And so I like this as a bond fund, but you just have to recognize it's not just a bond fund. It's also got stocks. So you have to make sure that works for you. And this kind of segues nicely into the bonus. From Dean, I watch your channel, love how relatable you are to the average investor. Good, thank you. I wanted to let you know the way I invest so you might share with others that it might help. The way I invest in my tax advantage retirement accounts is to put a target date fund in my traditional account based on the year I'm going to retire. So one example is target 2030, he says. Good. And then he says in the Roth, where he wants more stocks, he invests in a Vanguard target 2070 fund, which is stock heavy. It's probably 90+% stocks. He says this 2-fund portfolio gives me diversification and allows me to adjust my risk in the proper tax account location. I'll explain that in a minute. He can adjust it one way or another, and he points out too that it's good for his family because it just keeps things simple. And I really liked this idea. And so the idea with asset location is, in a perfect world, we'd keep all our bonds in traditional retirement accounts. It shields them from taxes, so that's why we might not want them in a taxable account. But we also don't want them in a Roth account if we can help it, because we want the Roth to grow as much as possible because it's tax-free, right? And so he accomplishes that by having a target date retirement fund in the Roth that's, as he mentioned, a 2070. Let's look that up. I'll pull it up real quick. I could have done this before I started the video, but I didn't think about it. So here we go. Here's the 2070 fund. We go to portfolio composition. It's probably 90% stocks. Yeah, 91.34 stocks. So yeah, he's got a little bit of bonds in a Roth. Okay, that's fine. Remember, how's it go? Don't let perfect be the enemy of good. Perfectly fine. And for the 2030 fund, it's a lot more bonds. And if the two together get him to the overall asset allocation he wants, I think it's an excellent strategy. It's, at the end of the day, it's like putting together Lego pieces. You've got your asset classes. You want some international stocks, some U.S. stocks, some bonds, preferably some tips, in my view, if you can get them. But how you package it up, in my view, in this easiest, simplest way you can. And there are a lot of different ways to do that. And this is one that I hadn't really thought about. I hadn't thought about putting a 2070 fund in the Roth. I think it's a great idea. And it keeps things very, very simple. And it also, I think, highlights the fact that all of these things are tools. So a target date retirement fund, you may want to retire in 2040, but that doesn't mean you need to invest in the 2040 fund, right? There's no target date retirement fund police that are going to come knock on your door because you plan to retire in 2040, but you're invested in the 2050 plan, right? The numbers are just there to make it easy for folks to try to find a fund that's consistent with, where they are in their career. But you can invest in whatever you want, and that's exactly what he's done. I really like it. It's simple, it's low cost, and it gets the job done. So there you go. Well, I hope this has been helpful. Tough questions, again, because there's just not simple answers to these, and often they just yield more questions. Sorry about that, but that's how I think through these things. Hopefully it's helpful to you. I'll leave links to that Schwab calculator, and I guess the RE 1965 paper, although I think you have to pay for access, but you could always go to your local library if you really wanted to look at some complex formulas around annuities. Well, there you go. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.